Manias, Panics and Crashes. A History of Financial Crises by Robert Aliber, Charles Kindleberger, and Robert Macaulay. This is a book summary. Imagine this. It's a crisp autumn morning in October 1929. The air in New York City is thick with optimism. Inside the grand offices of Wall Street, stockbrokers toast to their ever-rising fortunes. The roaring 20s had turned them into kings. The Dow Jones is at an all-time high. Bankers, housewives, and factory workers alike are pouring their savings into the stock market, convinced that this new era of prosperity will never end. The radio hums with reports of yet another record-breaking day. But then, something shifts. The first cracks appear in the illusion. Stocks start falling, not by much, just a little. But in a world fueled by debt and blind faith, a little is enough. Panic whispers through the streets like a ghost, growing louder with each passing hour. The next day, the selling begins. By Black Tuesday, the entire market collapses. Banks fail overnight. Lifelong savings vanish. The American dream turns to dust. The Great Depression was born not just from financial mistakes, but from a dangerous cycle, one that Kindleberger and Aliber reveal has been repeating for centuries. Sound familiar? It should, because history doesn't just rhyme, it repeats itself. Booms and busts aren't just dusty tales from the past, they shape our economies, our futures, and even our personal lives. And no book explains this better than Manias, Panics, and Crashes, A History of Financial Crises by Robert Aliber and Charles Kindleberger. Today we're diving deep into why financial crises happen, how they evolve, and why, despite knowing the risks, we keep falling for the same traps. Act 1. The Anatomy of a Financial Bubble. Every financial catastrophe begins the same way. It starts not with panic, but with pure, intoxicating euphoria. This is the future. You can't lose. Prices will only go up. These aren't just the words of modern-day crypto enthusiasts or dot-com investors. This is the same siren song that has lured in every generation of speculators since the dawn of finance. Picture this: the Tulip Mania of the 1630s, where a single tulip bulb was worth more than a house. The South Sea Bubble of 1720, where investors bet their fortunes on a mysterious company promising wealth beyond imagination. The Railway Mania of the 1840s, where people poured their life savings into the promise of steel tracks and endless profits. Each time, the story is the same. 1. A new technology or market emerges. 2. Investors flood in, believing this time is different. 3. Prices skyrocket, fueled by borrowed money. 4. Greed takes over. The modern world isn't immune. In the dot-com bubble of the late 90s, companies with no earnings and barely a business plan were being valued in the billions. Amazon, Pets.com, Yahoo. It was a gold rush until it wasn't. By 2000, the market crashed, wiping out $5 trillion in investments. And then, just a decade later, history repeated itself. But behind the scenes, something far more dangerous was brewing. Act 2. Debt and leverage. A mania isn't just about rising prices. It's about how people fund those prices. Here's the secret. Most bubbles aren't built on real money. They're built on borrowed money. Kindleberger and Aliber explained that excessive credit expansion is the lifeblood of every financial bubble. Think about it. In the 1920s, margin loans let people buy stocks with just 10% down, borrowing the rest. In the 2008 housing bubble, banks handed out mortgages to anyone with a pulse. No job, no income, no problem. In 2021, crypto-leveraged loans allowed investors to bet 10x their actual money on digital coins with no intrinsic value. At first, this makes everything feel great. Easy money equals more buying leads, prices go up. Rising prices equals more confidence leads to even more buying. But there's a tipping point. A moment Kindleberger calls distress. It's the moment people realize that prices don't just go up forever. And then, the crash begins. At first, it's subtle. A few missed payments, a shaky quarter from a major company, a tiny drop in prices. But suddenly, everyone remembers a terrifying truth. Debt must be repaid. Loans have interest. And when prices fall, there's no easy way out. When that realization sets in, panic spreads like wildfire. Cue the run on the banks. Investors rushing to sell. Governments scrambling to intervene. What follows isn't just a market correction. It's a full-blown financial disaster. The question is, can we ever escape this cycle, or are we doomed to repeat history forever? Like an unstoppable avalanche, it begins with one tiny crack in the mountain. At first, it's barely noticeable. A single snowflake drifting down, a whisper of uncertainty in the markets. But then, a bank collapses. A single institution, but one that held the confidence of millions. Suddenly, that confidence shatters. A company's earnings fall short, just a little off projections, but enough to make investors uneasy. Interest rates rise, just a fraction of a percent, but it's enough to tip the first domino. And then, the illusion vanishes. It's like watching the moment a magician reveals the trick. Investors who once believed in infinite riches suddenly realize they've been standing on a house of cards. And then, they run. Prices plummet, banks fail, unemployment soars. The panic spreads like wildfire. First, it's just the stock traders on Wall Street, then the bankers, then the everyday people lining up at their local bank, desperately hoping their money is still there. But it's not. News reports. The Great Depression has begun. Lehman Brothers collapses, triggering a global meltdown. According to Kindleberger, panic is contagious. Once it starts, it spreads beyond borders, beyond industries, beyond reason itself. What started as a financial bubble bursting in one sector soon infects the entire system. The 2008 financial crisis is the perfect example. It all started with subprime mortgages, risky home loans packaged into complex securities and sold as safe investments. When the housing market crashed, banks across America crumbled. But it didn't stop there. The crisis is now spreading to London, Hong Kong, and Tokyo. Global markets are in freefall. As Kindleberger explains, no financial crisis is ever truly local. In our interconnected world, the failure of one major institution can bring the entire global economy to its knees. And here's the terrifying part. Governments and central banks rarely see it coming. Why? Because each time, they convince themselves, this time is different. But as history shows us, it never is. Act 3, the aftermath. Can we prevent the next crisis? So, what happens next? Do we learn? Do we change? Do we break the cycle? Nope. The world rebuilds. New regulations emerge. Banks promise to be more responsible. Governments vow to never let this happen again. And for a while, things look stable. But then, we forget. History shows that financial crises don't happen because we lack the knowledge to prevent them. They happen because, over time, we lose the fear. Time passes. New industries rise. Markets boom once again. And then, greed takes over. These returns are incredible. Get in now before it's too late. This market is unstoppable. The same patterns repeat, because financial crises are not random events. They follow a predictable and inevitable cycle, just like Kindleberger and Aliber detail in Manias, Panics and Crashes. The 5-stage pattern of every financial disaster. 1. Displacement. A new opportunity excites investors. Think railroads in the 1800s, dot-com startups in the 1990s, or crypto in the 2020s. 2. Boom. Prices skyrocket as investors rush in. This is the new gold rush. 3. Euphoria. Greed takes over. Banks lend recklessly. Debt explodes. It will never crash. 4. Crisis. A trigger causes panic. Wait, why are people selling? 5. Panic and crash. the entire system unravels. Bank failures, unemployment, recession. Can we stop the next financial crisis? Maybe. But Kindleberger's analysis suggests we probably won't. Why? Because markets aren't rational. People aren't rational. By now you've seen the pattern, the euphoria, the mania, the panic, and the inevitable crash. We like to think we're smarter than the people who lost everything in 1929, or the investors who poured billions into dot-com stocks in the 90s, or the homebuyers who borrowed beyond their means in 2008. But are we? This time is different. That's what they always say. Kindleberger warned us decades ago. Markets are not driven by logic. They are ruled by fear and greed, and the moment we believe we are smarter than history, we set ourselves up for disaster. So, what can you do to avoid becoming the next victim of a financial collapse? 1. Don't fall for hype. If it sounds too good to be true, it probably is. Bitcoin to $1 million, housing prices will never go down. Stocks only go up. History says otherwise. That moment when people stop asking questions and start believing in magic, the higher the excitement, the harder the fall. If everyone around you is suddenly an expert in the latest financial trend, it's time to take a step back. 2. Watch out for excessive debt. Debt fuels every financial bubble. The Roaring '20s, investors borrowed on margin to buy stocks. The 2008 housing bubble, home buyers took on massive mortgages they couldn't afford. The next crisis? Look at the record-breaking consumer, corporate, and government debt levels today. Debt isn't just a problem, it's the ticking time bomb behind every financial disaster. If people are borrowing money just to invest, be very, very cautious. Understand history. Because what happened before will happen again. The patterns never change, only the details do. Tulip bulbs in the 1600s became cryptocurrencies in the 2020s. Railroad stocks in the 1800s became dot-com stocks in the 1990s. Subprime mortgages in 2008 might just be AI stocks or meme coins tomorrow. The names, industries, and technologies change, but the human psychology behind the madness remains the same. If you hear the words, "It's different this time," run. So, what do you think? Are we in another financial bubble right now? Will history repeat itself, or have we finally learned our lesson? Drop a comment below and let's discuss. Like and subscribe for more insights into the world of finance, history, and economic disasters waiting to happen. Want to dive deeper? Pick up Manias, Panics, and Crashes. Because the more you understand history, the better you can protect your future. And remember, those who forget the past are doomed to buy the top.